things for you. It could produce appreciation, it could produce cash flow, or it could produce a tax write-off. That's all the dollar can give you. It's because your 100 hours have to be more than anyone else. If you have one cleaner going in every 7 days cleaning your property, you're already out. You don't lose them. So they keep going there unless you die. If you die, don't die with passive loss. From all over the United States, which is great. I want to say welcome again. Today's sessions, if you were here last month, we're doing this Q&A session for our community. And I want to say thank you for being part of what we're trying to give back. This question is, my spouse doesn't really work. Can we just call her a real estate professional and wipe out my W-2 with rental losses? Now, the real estate professional status, it's really not just about the hours. Even if your spouse doesn't work, you could say, oh, does you have enough hours, right? So it has to be a combination of things. So one of the two major tests that really have to be met to be a real estate professional, you can't just say somebody is a real estate professional. To put it on your tax return, you have to have more than 750 hours in real property trades. Okay. Now, that doesn't mean necessarily you go and look at properties or managing rent. If you have one rental property or two rental properties, that's all you do, it's almost impossible to meet those 750 hours. And if you do, you want to keep a log because it's just very little for you to meet that. And that's test number one. Test number two is going to be that more than half of your total personal services, right, have to be in real property, in real estate. That becomes problematic if you have no income, or you have other income or you have investments or anything else that you're producing. Your personal services have to be in real estate. If you're doing some other things, it might not work. So that material participation that you need in real estate professional many times kicks people back, like they count on, oh, I can just put it in because, well, she doesn't work, she's a stay-at-home mom, or we don't dismiss that because somebody doesn't have a W-2. And the reasoning, and I can hear the reasoning, because every time we have someone who has a W-2 or you have a spouse that has a W-2, we're like, you cannot claim it, right? The IRS has I don't know if there's any court case with a person with a W-2 that has been granted real estate professional when they were under audit. So the reasoning is great, but you want to meet both of those tests, right? No W-2, or the half of your total personal service hours have to be in real estate, okay? And the 750 hours. And if you don't know, find something. Now we're in the age of AI. Use AI to create a log, or to create a memo or something. You use your phone and you just record it. Hey, I'm doing this and this, and give it to AI to create a log for you. Now it's the easiest time it's ever been to create these types of logs. And I know everybody hates it when I say create a log, but listen, to defend yourself if something happens, the only way you can defend yourself is really to have paper, to have some document to prove to the IRS. The IRS doesn't care about the story. They might if you get to court, but it's not worth it. So if you can create a system, like, okay, if I can create a system for me to log my hours and I truly come very close, or maybe more than 750 hours, yes, I have no problem putting it in. Okay. So again, the hours and that material participation that you want to make sure that you have. There's some other ways you can create that real estate professional status, but this is the classical way, I should say, right? And I hope that answers your question. Once qualified as a real estate professional last year, that I can stay qualified for periods. Absolutely not. So real estate professional standard has to be, you have to qualify every year. And yes, absolutely. Yeah. So there's some things that you want to understand. Anything that has to do with material participation, because I see a lot of the questions today were around material participation, active participation, between active income, passive income, and whatnot. All this active material participation, real estate professional, all these things, they are standards that you have to meet yearly. Okay. You don't just do it once and you're done for 5 years. None of them. So active participation has to be done every year. Material participation, if it's the 100 hours, absolutely has to be done every year. If it's 750 hours for the real estate professional, it has to be done every year. So you're not good to go. Okay. So it's not, you don't get nothing from the IRS every year. And you can absolutely do, be qualified one and not be qualified ever again, or have every year qualified and one year that you're not qualified. So yes, thank you. That was a great question. As a real estate professional, help me avoid NIT on a capital gain of a property sale. Listen, the real estate professional doesn't do any magic. The real estate professional only will give you losses that you have. If you don't have losses, they're going to give you anything, right? So it's not going to give you that. So depending on what other income do you have, you can still get hit with the net investment tax on your return. I want to address one thing here because I have some comments on the short-term rental loophole. So with the short-term rentals, the premise on the short-term rentals, and I have quite a few different scenarios here with the short-term rentals. People say, well, if you have a short-term rental, you automatically can go in and kind of have all the losses pass through to your return, almost like you would be a real estate professional. Well, yes or no. And do you guys want me to be very honest? Here, do I have your permission to be very honest? Yeah. Okay. So nobody's telling you. So the social media, like, and probably I'm guilty of it too. Like social media is always trying to portray you the great and the greatest. It's not giving you the ugly and the ugliest. Okay. But a short-term rental could act, can act. I'll give you like a very, short synopsis of how do you think about short-term rental. You have to assess it from the same standpoint as the real estate professional. What am I going to do with that short-term rental? Okay, so let's say to qualify as a short-term rental, I have to have an average stay of less than 7 days. Okay, we planned that. It's all in your power. You can have one stay that could be much longer, that could really completely mess up your average stays, that you could have more or less than 7 days. But let's say you can control that and you have less than 7 days average stay for a full year. Great. But that's not it. It still requires material participation. Okay. Let's say you have like in this case, we don't need 750, we need 100 hours. And many people say, well, I spend 100 hours, I collect rent, I do this, I have a company who's doing all these things. The problem with the short-term rentals, and here's the kicker where a lot of people get kicked back from the short-term rental loophole, is because your 100 hours have to be more than anyone else. If you have one cleaner going in every 7 days cleaning your property, you're out. So what happens if you're out? So a short-term rental, for it to give you the highest benefit, it is when the short-term rental gets treated as a business. When you actually materially participate more hours than anybody else, and you actually deliver, you actually do some services, you do some work, like you might do the cleaning, you might do the bookkeep, like the bookings, or you might come in and welcome people in and out. You might do some other things, but you have to have some services that you're doing within your short-term rental. Okay. If you're not doing that, even if you have 100 hours of material participation, it will still be treated as a long-term rental. The losses will still not pass through. So the only way your entire losses will be passing through as a business to deduct all of it is if you actually materially participate and you provide services to the short-term rental. If you hire a management company that does all your booking for you, you have a cleaner that comes and cleans, you managing all these people is not going to get you there. So a lot of people are buying short-term rentals thinking, okay, this is the greatest and the greatest, which it could be if you're planning it and you are actually, doing all the things as you're supposed to do. Because that's the catch. People don't know. And then it goes out. You go file your return and say, well, it's not a qualified short-term rental. It still goes on your Schedule E. It cannot be a business. Plus, one of the issues with that is the minute that you have a short-term rental, the depreciation, kicks you from 27 years to 39 years. So a lot of people miss that. So if you have long-term rentals, okay, so long-term rentals, you depreciate them as 27.5 years, right? So the IRS has like it's this arbitrary number that got picked as how long could you depreciate, right? Or recuperate the cost of you purchasing that building. So when you buy this property, long-term rental, if it's a residential, right? Long-term rental, it's going to be 27. The minute that you put it as a short-term rental and it's less than 7 days, it classifies now you're like a hotel. You get treated as a commercial building, and the commercial building you recoup the cost in 39 years. So make sure you know the rules and don't just fall prey into, okay, it's very hot. Short-term rentals have been very hot for a while now, but we see some damages done by short-term rentals to people who have not understood how short-term rentals play long-term. Makesh is asking, if I do not have material participation, is there any benefit of acquiring a short-term rental as opposed to long-term rental from a tax perspective? Yes and no. So you have to like, who has been around what I teach for any extent of time knows that I always give this analysis of the dollar that you put in to work for you. So every dollar that you invest has to produce one of the three things for you. It could produce appreciation, it could produce cash flow, or it can produce a tax write-off. That's all the dollar can give you. Okay. Now, when you invest in real estate, does it matter necessarily if it's long-term or short-term? Yes or no? So you're looking, I'm not going in for a short-term or long-term. I'm looking, what am I trying to achieve? Once you can get very clear, what are you trying to achieve? It's easy for you to choose the tool. Short-term, long-term, I could care less. I'm looking for a benefit. What's the benefit? So people go to a short-term because either they want higher profits or they might want a higher tax write-off. But knowing what you're looking for, it gives you a clear guide of what do I do with this piece of property? Does that make sense? So let me say that again. Every dollar you put in, you put it out in the world to do something for you. It has to come back with, it has to produce appreciation, cash flow, or tax write-off. Can you think of anything else that the dollar that you put into work for you, can you think of anything else that dollar can produce? Those are the only three things that dollar can give you. Okay. Real estate is a perfect example because it can give you all three. Not in the same proportion, not all at the same time. So a short-term rental, let's analyze that. A short-term rental gives you a higher cash flow because you're renting it more often. It's just higher rates, nightly rates, and whatnot. So it can give you higher cash flow. Appreciation stays the same. So with higher cash flow, it gives you higher tax write-off. Maybe. Okay, depending how you have it set up. In exchange for that, like let's review the long-term rental. A long-term rental, what does it give you? It gives you steady cash flow, not necessarily the highest, it depends. Appreciation is the same as a short-term rental, and it may give you write-off, tax write-off, or it may not, depending on what kind of income you have. How are your sources of income? Who holds your real estate? Is it you? You already have high income? Is it you hold it in a corporation? You hold it in a partnership, in an LLC, in a trust? Whatever the case might be, like you may not get the tax advantage today. You might only get it when you actually sell it. So it depends. So when we're talking about short-term versus long-term, it's a tool. So real estate, number one, is going to give you appreciation if it's a good piece of property. If not, sell it out. 1031 it. The biggest mistake people make is holding on to real estate much longer than they're supposed to. Real estate loses its ability to give you, for example, there's some areas, and we've seen now San Francisco is going down like drastically in terms of appreciation in some of the areas. They have, we have people with like great properties who have been doing very well, commercial properties, residential, because of the homeless situation. They cannot even function in those areas. So what's the likelihood of that property appreciating a whole lot unless there's some real change in the actual, policy of the city, right? Or the county. So with that in mind, you also want to think about the economic benefit. Like, do I have an economic way of this property appreciating? If not, you might want to just exchange it. So I hope that makes sense. So from a tax perspective, it depends on your situation. You might have the best use of a short-term rental, especially if you have a spouse who's actually involved, who's actually doing different things, or you might have a benefit from a long-term rental. If you're a real estate professional, it really doesn't matter what you do. Okay, so I hope that answers your question. I make 400,000 on a W-2. My friends with businesses pay nothing in tax. What can I actually do besides quitting my job? Well, we wouldn't want you to be quitting your job, right? So, is it fair? Again, the tax system doesn't seem fair many times, and I'll go and explain the best way I can. The business owner gets favored somehow by the tax system. And it's not because necessarily they're special people or that the people who passed the law, and this is again just my own theory. A business owner has to take so much risk. And when you think about the fact that, 93% of the businesses fail in the first, I think, 3 years, that the fact that somebody was able to build a business and made it to 400,000, even if they make the exact same amount as you, the amount of risk that they have to go through is much higher. Hence, they have access to more deductions that you do not have access to as a W-2. And somebody came with a valid question. And, somebody came to me as a pilot saying, I used to be able to write off all my per diems, all the nights, all this other meals, and all the expenses that I have. I used to be able to write everything off on my return as a W-2. And a pilot can make anywhere from, 400 to maybe $600,000, right? Or maybe more. So when you think about that, the law and what was in the past unreimbursed employee expenses, which was deducted on your Schedule A as itemized, there were so many audits. Why? This is the reason, and I really want you to hear my heart. I'm not saying that you're doing something wrong or somebody did something wrong. I've had the, I don't know, the benefit of representing so many people in different types of audits. The unreimbursed employee expenses, 99% of the time, people could not prove their expenses. Over an extended period of time, when the IRS is going in and this piece of law that's in effect, and people are claiming all this expenses as an employee, which was used and abused in every way possible, that law was repealed, like it was changed. And it's because we as humans, if something good gets passed that we can actually take advantage, we are absolutely abusing the piece of law. There are so many right now that are being abused. Will that happen if the IRS starts auditing and creates projects? And if the IRS audits that piece of law and there is no compliance, meaning the people cannot prove. If you say I had uniforms, I had my dry cleaning, it was my dog, it was this, like anything that you can imagine was on those lines on the return, the IRS will take it away, which is very, very sad. Now, when that law was repealed, what happened was the employees were supposed to go back to their employers and negotiate a reimbursement from the employer. If you truly, and this was the IRS standpoint, if you truly have unreimbursed employee expenses as an employee, okay, the employer should pay you reimbursed expenses, something what's called an accountable plan, right? Now, the employers, many times it was not required by the employer for you to have X, Y, and Z, right? People were deducting above and beyond what they were supposed to do. Now, that's kind of like the 2 cents of what happened, why people were able to claim expenses against their W-2 income, and now they can't. So, was it a good thing that the law was changed? I don't know if it was a good thing or not. So, as a W-2 employee with a 400,000 income, if you're single or married, depending on the state you live in, it will be very difficult for you to reduce your tax bill unless you do investments. And investments, remember, we talked about the dollar. Investments have to have very specific thing. Like I'm investing in something that could give me either a depreciation, that could give me some energy credits. It has to be an investment in which you would have out of the three things that the dollar can give you, right? Out of the appreciation, cash flow, and tax benefit, it has to be higher on the tax benefit. Okay. And this is the mistake. People who go in as a W-2 employee, they want it all. They want cash flow. They want this. If I'm going to invest in this, I want to get it all. You have to be very focused as a W-2 employee. You have to pursue the actual tax benefit because that's the only thing that will reduce your tax bill. unlike the business owner who has access to multiple types of deductions that are available to business owners, which with this, I hope this answers your question. So it requires investment, right? How much? For a 400,000 tax return, depending on if you're single or married, you cannot save money unless you invest a minimum 25 to 50K. That's a minimum, sometimes even more than that. And the question says, I am a direct owner of a new oil and gas well that was funded. And again, it goes into some details in 2025 and took intangible drilling cost deduction in 25. Now, after drilling was done, completing all of that in 26, they completed all the drilling, and they determined that it's lower than the estimated values, and now they have a return on capital of the difference, right? So you put in, I don't know if it says how much you put in, but he's getting back $10,000 as a refund. And the question was, is that recapture? So technically, when you go into an oil and gas deal, they shouldn't refund if there's excess cash. So, which that's a very interesting standpoint, because it could be treated more like a deposit than the actual investment. So when you invest in oil and gas is a great deduction for a person like we mentioned, a high earner. Putting money in oil and gas can give you a write-off. Yes, it can give you a write-off. And the way it can give you a write-off in year one, you would be materially participating with the minimum 100 hours and you're active, in which case you get to deduct the intangible drilling costs. Okay. If those costs are lower and you get the money back, depending on how it's treated, you can either go back and amend your 25 and say, hey, it's actually not 50,000 or 70,000 as I put in. It's only, whatever, $50,000, or the excess that gets returned to you may actually be classified as income. Okay. I don't know of any recapture on oil and gas on drilling cost. The recapture is only on property. So I don't know if you're here. I got this, via email. It's not truly recapture, but it could actually be ordinary income. So what I would do at this point, if this is you who had this investment, I would ask for a breakdown from the operator to give you exactly how it was treated and how your investment is treated, so you know exactly where it goes on your return. But it could be ordinary income for you. What is your take on utilizing investing in workforce housing and equipment rentals to offset taxes for W-2 earners? That's a great question, Terry. And I'll tell you my number one take on any type of strategy that is out there. There's so many. So what we analyze the type of income. What kind of income do you have? If you have ordinary income, earned income, right? What kind of strategies will work for you, and how could you write them off? Many times, if you have a high W-2, they could work as long as you understand what the deal is. What I don't like, I'll tell you, one of the things that people many times don't understand. Some strategies are not elimination strategies. Some strategies are deferral, meaning you're not paying taxes today, but it's coming up. Like we talked about the recapture might come back and hit you. So when you go into any investment, every investment that has some benefit could be a great investment. The question is it great for you? That is the number one question that I would ask you. Is it great for you? Is it a good fit for you? Right? So once you understand the full kind of play of a strategy, from how you enter and how you exit, how that, like, does that need another strategy when you're done? How are you going to close out? Like, how long are you hooked up on that? Like, what do you actually have to do to get out of it? So once you understand all these details, and if it still fits your scenario, I say it's a great deal. Many of these I don't like for people with high earners. So unless you have about $1 million in high earned income, combined spouses and whatnot, I would not go into the strategies. There are many other things that you could potentially do that, depending on your case, that you could do. So I guess if you're in a state with no taxes, maybe 700, 750 is the place where I would even look at these types of strategies. So advanced tax strategies have a place, and they're called advanced for a reason. And I'm not one to say, oh, it's for everyone and every stage. And the reason why I say that is because you've got to first deplete the lower end. Use your cash, use strategies that you have control over your money first before you put it out to the investments that are advanced strategies, because you have to understand like how the ball is rolling. When you control the money, you control the output from the beginning to the end. Then you go out and invest in other investments that you don't have the control necessarily. So I hope that makes sense. But again, I've seen equipment rentals, great strategies. We've used many of them of various kinds. The housing, again, has become hot. Now, I would be very cautious of, there's so many groups. And again, I'm not against any group. And many of them are investment groups who go in, and a lot of the people are that are coming in kind of fall into that, oh, we're going to miss this out. It's the greatest strategy, and they don't even need it, right? Or the cost of getting into strategy is so high that is way and beyond what their tax bill would even be. And they don't even know what their tax bill is, but they're like, they make it sound like, oh, this is the greatest strategy, we must invest. So you have to be very cautious sometimes. And when you see a strategy, the question is it good for you? And is it good for this year? Right? So housing, great strategy. I love the strategy. Is it for everyone? Absolutely not. Absolutely not. And understand, if you're in one of the states with no state tax, like a Texas or Florida and whatnot, your income has to be much higher than the other states to really come up with the ROI for that strategy. So again, that's I hope that answers your question, Terry. Is asking, I participate in a lot of syndications as LPs. They generate depreciation to offset taxes in K1. Question is not sure what to do after 5 years exit. Do I ask them to 1031 this fund to another deal, or what the best strategy after exit? You have to know what's your end goal and your exit before you enter in these deals. So I've seen people with 20 syndicated deals, with 40 deals in, and they just invested in anything that came in. So what do you think the end goal would be on that? So help me out in the chat. Let me know you guys are still awake. What do you do? So give me an example. Anyone in here? I know most of you are investing in one way or another in some sort of, passive investments. Everybody's doing something. What do you do if you don't know the end goal? Right? You go by like whatever seems right. But you would not know if you actually met your goal or you didn't meet your goal. And I'm going to sound like a broken record. What can a dollar do for you? A dollar can give you appreciation, a dollar can give you cash flow, and a dollar can give you tax write-off. When I go into multiple syndicated deals, right, that what am I trying to achieve? If I'm going in for the tax write-off, right? So yes, says cash flow plus K1 depreciation, but how to avoid recapture? You can't. So that's the idea. So you understand that it's almost like a game, right? And it's not a game. I just don't want you to take it literal. It's almost like once you understand that when you invest, you enter a race. You cannot just enter into these investments to get the cash flow and not think, how am I going to get out? If you're getting the bonus depreciation, not thinking that this is going to come back to you, that's wrong, because you're going to get hit, right? So when I get in, if you're going to have multiple investments that are going to come out, could you do 1031 exchange? Possibly, that's a choice. But again, you have to invest in something else. So once you have high recapture, high gain from one deal, you have to invest in another deal that gives you another high bonus depreciation. It gives you more, more of the same things that you got when you invested. So it's almost like a ball that always has to keep spinning. It has to keep rolling all the time. So what I want you to really grasp, and I know you probably want me to give you very specific things. You do this, and like everybody's asking me the same thing. I need to know what to do. Can I do this? Give me A, B, C. It's not that easy. And it's not because I'm trying to avoid the answer. It's because it depends what you're trying to achieve. Is this in your personal name? Is this in an LLC's name? Is it for succession planning? Is it for legacy? What are you building? Is it like, are you looking more at, okay, I want to bring my kids in, it's going to be multi-generational? Like it depends so much on your scenario that it's almost impossible to say, okay, this is everybody has to go exactly, this is the only way you could do it, or A, B, and C. It doesn't work like that. You have to choose the end goal. And when you invest, okay, I have all these properties who are like that are giving me cash flow right now. I'm gonna choose the next investment that maybe it's gonna be some energy deal, or maybe it's gonna be something else that's gonna be high write-offs, right? Regardless of what the other properties are doing. If I have high appreciation and I want to exit, maybe I want to do 1031. It all depends. But absolutely, in 5 years' time, when you exit, you have to think about, what do I want next? What do I need? And you pair, right? If one gives you appreciation or it gives you a high gain that year, you buy another investment or you invest into something else that will give you that tax write-off that you're looking for. So I hope that answers your question. You can do any of those things. Which one will work for you? Again, it depends. Not all deals are 1031 deals. Sometimes investing into another piece of property and getting the bonus depreciation makes the most sense, especially if you're a real estate professional. So Marty's saying, I invested in oil and gas deal. Can I take the intangible drilling costs on this deal if I am a limited partner, a passive investor? Okay, you cannot. And why is such a big difference between passive income and, when it's a passive investment and an active investment? You have to understand that if you are passive, it will only reduce the passive income that you have. It will never generate a loss. And if you cannot generate a loss, what it will happen, it will not offset other type of income. So when would you invest in oil and gas? If you have a high W2, or if you have, high S-corp profits, you put into an oil and gas deal. And if you're an LP, unless you have other passive income, it will not generate a loss to offset any other source of income. If you're active, however, it can give you that intangible drilling cost that could actually go negative, and it will give you offset other type of, the loss becomes deductible, is what it means. So absolutely, you have to be active. Most of these deals, you will be active in year 1, and they switch you to passive in year 2. So I hope this answers your question, Marty here. I'm looking at that. So it says the answer to my question is I can write off against my passive real estate then. Yes and no. So depending on how they give you, so it's going to be a passive loss. So passive loss, okay, great question, Marty. So passive losses of any kind that you have will go, there's a form on your return 8582 that will kind of track all your passive income and passive losses. The minute you have passive income, it might unlock your passive losses. So depending what you have sitting in that form on your return, it could unlock other passive losses if you generate passive income from any other source. Yeah. So again, yes or no, it all depends how the form gets flushed and what do you have on that form on your tax return. So in a way, to make it really, really simple, it's almost like a bucket, right? So you dump all this passive losses in your bucket. Usually income gets taxed right away. So passive income, you're not going to carry to next year, but passive losses you do, because if you don't have, you can take them, they get carried forward. And there's a form on your return that tracks what you carry forward. And it's going to have real estate, it's going to have K1s, anything that you have that has been carried forward as a passive loss. The minute that you have passive income, this bucket now has accumulated all these losses for, how many years you have it. And there's no time. You can keep carrying forward and forward. You don't lose them. So they keep going there unless you die. If you die, don't die with passive losses. Bad joke. Sorry. Back to the question. When you have all these passive losses in the bucket, the minute that you have passive income, it unlocks some of those passive losses. Okay? So that's how passive losses get treated as a whole. It's not like they go in this, I don't know, universe and somebody picks them up. Oh, we're going to pick this, we're going to pick this. It's a bucket. Everything is there. On your return, you go and you search for 8582. That's the form. Okay. So I hope that answers your question, Marty. Yeah, I did have one more coming in. If I make the same amount as last year, why did my tax bill explode? Again, you will not have 2 years exactly the same. right? Even if the income could be the same, you could have like, age can put you in a different bracket. You could have a kid that's older. You could have the withholding from your employer, the net investment income. AMT, if anyone is around and has been around for a few years when AMT was a big deal, AMT is coming back, and we're going to see, big damage from AMT, especially if you have passive income, all this other, long-term gains, and especially if you're a high income earner and you have any type of stock options, RSUs, with the state taxes that are going crazy in the last few months, we're being very surprised by some of the states. So AMT is going to make a huge deal of damage on the tax returns. So even if you make the same amount as last year, you still need to be a little bit proactive to understand what kind of changes will affect your return. So I hope that answers that question. Thank you for joining today, and I'll see you next time. Make it worth it. Again, I am here for you. If you have any specific questions, send them out. Okay. Thank you, everyone. Have a great weekend ahead, and I'll see you next time.